Welcome to On the Front Line with AI. This podcast series examines how artificial intelligence is being used to combat money laundering and other types of financial crime. This edition focuses on how financial institutions are adopting AI to find financial crime that current process-driven efforts are just missing. We'll be discussing why, with significant investment in AML efforts, money laundering is not abating, the ways AI is being applied against the problem, and if regulators are advancing or hindering progress in this area. With us today is David McLaughlin, CEO of QuantaVerse, a leader in artificial intelligence and machine learning solutions purpose-built for identifying financial crime. Dave, welcome, and thank you for taking time to join us.
It's great to be here.
Great. Well, I have really been looking forward to this episode because it addresses the issue that frustrates so many who've dedicated their career to financial crime compliance and AML. Namely, that we're spending a tremendous amount of time, energy, and money trying to find and regulate financial crimes, yet estimates are that well over 50% of them still pass right through the financial institutions unidentified. Why, given the significant increases in AML efforts and enforcement, aren't we getting any better at driving money laundering out of the system?
Well, first, let's just give a nod to the complexity of the problem. It is by no ways an easy challenge to solve. Criminals are very adept at moving their money around the globe. They're very adept at hiding those money movements. They know exactly how financial institutions are trying to catch them move that money, so they're able to obscure those cash flows and that money movement very adroitly. So it is in no way an easy problem to solve. It's very complex and very challenging. But after we get that nod, let's talk about what can be done to improve the situation. And the question that you're asking about what can we do to make it better and make less of those crimes go unidentified really stems from the problem that the reality that AML and KYC compliance and the related regulatory requirements were established back in the 1980s, and they were based on what was possible at that time with the technologies at that time to measure and test. And the technologies clearly and obviously have made a lot of advancements since the 1980s. So that's one challenge. And for this reason, the covered FIs and the regulators who've been working with them have become very well trained to focus on process metrics. Those metrics of number of SARs per transaction, number of analysts per SARs, how to maintain and update a TMS with rules and models, cooperating with monitors and oversight committees on the process that they need to put in place, keeping up with KYC information for clients, or maybe not keeping up with KYC information for clients because it's so complex. It's a process-driven environment today, and regulators hold their covered institutions accountable for maintaining and executing the processes, and not for actually reducing the number of financial crimes going through their organizations. However, today, the advancement in the technology that I was referring to is with this data analytics and the ability of data analytics and big data to now look at what is possible and now look at the changes that are possible. And instead of measuring process execution, we can begin to measure outcomes, and we can be very effective at reducing financial crimes, not just by checking compliance boxes and process boxes, but by actually looking at crimes that are going through the organization.
That is a great observation on why we're measuring the way we are, or monitoring the way we are. So, but in the meantime, every institution, including the financial industry, has begun using data analytics, AI, machine learning in really meaningful ways. What has kept these types of advanced technologies out or away from the anti-money laundering challenge? Why aren't we taking advantage of them, putting them to good use?
Yeah, sure. The short answer to that is because it's a highly regulated industry and a highly regulated process within that industry. We've put as a society a huge focus on AML and CTF, counterterrorism financing, since 9/11. And with that increase in regulation and that increased compliance burden, covered institutions just do not want to upset the regulators by changing the process. They're going to be on the tail end of this. The regulators and legislation will have to change the process themselves and what it is that they do, and then downstream from that, the institutions will change. Regulators are examining the process because, again, in the 80s when these regulations were written, that's what they instructed them to do. The legislation, specifically states, the manuals specifically state that they will evaluate process, and they will not hold a covered institution accountable for actually catching financial crimes. They're hoping that a good process will catch the crimes, and as they evaluate that process, that things will work out well. So it's how they've been trained to do it, and it's how they've been trained to think about enforcing it. It's become a cultural mainstay of this ecosystem. Now, it's important to be clear, there are financial institutions that are using these technologies to reduce their risk, reduce their costs, and reduce their exposure to economic sanctions and make their processes more effective. But they're applying this AI and AI to this AML problem in ways that regulators are comfortable with today.
Where are those places? Where are they applying now that's making a difference?
The first way, in the right way, is in identifying the false negatives. The number that you spoke of at the opening, around 50% of these, the estimates are that 50% of crimes go unnoticed. There are some estimates that it's up to 90% if you go and account below the line transactions as well. But there's a huge amount of transactions that get through an institution that are just never identified, never flagged, and never investigated, and never reported. And that's the first place that can be these technologies can be used. As a matter of fact, we believe at QuantaVerse that's the first place it should be used. There's no use applying artificial intelligence and these technologies to reduce false positives and lower costs if you can't prove that you are finding the crimes that should be found. So false negatives is the right first step to do it. The second area that organizations are applying these technologies is prior to transaction monitoring and cleaning the data and enriching the data before it goes into the rules-based engine to evaluate whether there's an anomaly present. There's a huge challenge, obviously, with data and cleansing of that data and normalizing that data and enriching that data with valuable information to be able to determine whether a specific rule has been violated that needs to raise a flag. And this cleansing and enriching of this data has been shown to be able to drop false positives by a significant amount. Just get the right data in, get clean data in, get the data that the system needs to be able to look at a rule, and evaluate it versus a rule, and there's a significant benefit out of that.
Well, those are huge applications. You have also talked about some other places where AI is getting used against the problem of financial crimes.
Yeah, sure, but more than those conversations, in addition to the process, the places in the process, finding the false negatives after post-TMS or cleaning the data pre-TMS, is the organizations, the units inside of a company and how they can use it. And an example of that is this is a great technology for an audit department to use. Audits now take a random sample of data, something that they can consume, a size of data that they can consume. They take it at a scheduled time during the year when they're going to run their audit, and they hope by running that audit that they're finding that the business units that they're responsible for maintaining oversight of are doing that job. Well, with these technologies and this capability, audit can pull transactions or pull KYC files or pull whatever GL reports or expense reports, whatever it is that they're interested in, and pull all of the data. They can pull data for a year, 2 years, 3 years, whatever it is that they need to do to really run a robust audit. And that audit department's responsibility is to protect the organization. So by protecting the organization, by pulling all this data and using these technologies to evaluate it, they're doing a much better job of protecting their organization. Another example is there's the real possibility, the real capability now to have a perpetual KYC process. We joked a little and laughed a little bit about KYC because we all know that it's very hard to keep KYC files up to date. It's a very manual process on a scheduled basis, 1 year, 3 year, 5 years, whatever that schedule is, to go in and peck through customer files and peck through Google and try to manually update these files on some scheduled recurring basis, and it's a very manual and burdensome process. These technologies today can import transactions, it can import information from the deep web, from open source web sources, and build a true perpetual KYC process and have a insight into a customer that is not only not 2 or 3 years stale, but is valuable for both compliance reasons as well as for business unit reasons. So there's a real true value and a real true capability to create a perpetual KYC process. And then there are things like lookbacks, remediation, any sort of task or project that is being done that needs to look at a massive amount of data and create insight out of that data. These technologies are really ideally suited for. And then the problem that I sort of talked a little bit about or hinted about was on the above the line or below the line. Because we're process driven today and we're not outcome driven today, we've accepted an above the line, below the line environment. And we're okay saying we're only going to evaluate those transactions above the line. And anything below the line, we're just going to assume as a certain rate of financial crime involvement, and we're going to be okay with that. I mean, that can totally change now. We can truly look at all transactions above the line, below the line in almost real time and be able to understand whether there's risk involved in those. And that should be certainly something that the regulators are happy about, something that large global institutions are happy about, and especially something that a small community organization is going to be, community or regional organization should be happy about. I mean, criminals are going away from big global institutions sometimes and going to smaller institutions when the transactions that they have, when the money that they have can be broken up into smaller units. And that is a below-the-line risk, and that below-the-line risk can be solved.
All of the examples you just gave have huge amount of efficiency improvements along with them. Can this be a net positive to the bottom line in addition to improving the outcomes?
I think there's huge financial benefits, and we've seen that there are huge financial benefits of using these technologies. And just off the top of my head, there's 3 areas that financial benefit will be made clear. And the first one is in the de-risking area. These technologies are very good at finding specific individuals that are presenting risk to an organization. And instead of wholesale de-risking out of an entire market or wholesale de-risking out of an entire product line, organizations now have the opportunity to say, I'm going to stay in that market and I'm going to stay in that product line, and I'm going to use these technologies to understand which one of our clients in those markets are providing a significant amount of risk and which one of our third-party agents are presenting a significant amount of risk, and get rid of those specific clients in those specific markets. So the benefit of maintaining all or some of the revenue that an organization has, even while they stay in an area that regulators deem risky, is a very real impact to the bottom line. Everybody loves revenue, of course. The second area that could be a net positive is just the cost of technology are always going down, as everybody knows. Moore's Law applies to this technology as well as to any technology. And we've shown that we can build a capability at a fraction of the cost of a large rules-based engine. And so there's a huge huge play here in saving costs of technology, and that cost will continue to be driven out of the system. And then the third one is then the human capital efficiency. We're going to be able to use these technologies for what technology should be used for, and a lot of that is rote work that humans are doing today, and which humans, quite frankly, don't enjoy and don't get fulfillment out of their work, and they're going to be able to focus more effectively on what humans should be doing. So that human capital efficiency is going to be a natural outcome of these types of technologies.
Mm-hmm. So with all of these examples of how AI is already getting applied and can be being applied, is regulatory problem really that much of a roadblock, or can we do all of this without worrying about it?
Yes and no. No. As we speak, financial institutions are applying AI solutions in the ways that we just discussed, and they're radically changing the risk paradigm that they have in the risk environment, and they're dramatically lowering the costs of using these technologies. So, in that respect, no, regulators are not the roadblock or a roadblock. But on the flip side of that, I have to say, yes, the regulations are somewhat of a hindrance to the adoption of these technologies. There's a perceived need to protect regulatory harmony. No organization wants a regulator coming down on them because they're not comfortable with the technologies that they've put in place to combat financial crimes. And protecting that regulatory harmony is a natural and the right thing to do for an organization. So from that perspective, that protection of that harmony with the regulators is keeping some organizations from enjoying the benefits of these technologies that they could be using to really improve the effectiveness and efficiency of their programs.
So what should we be looking for regulators to do to change that, to loosen that, or clear the road so we can start really applying these new technologies to solve the problem?
That's a great question, and I think that's probably the most important question to ask. And it's one primarily of mindset, and it can be a difficult mindset shift for somebody, for an organization, for a government organization to make, but it is possible, and we're seeing it happen. And that mindset shift is, what I've alluded to. It's a change from having a monitoring process of an organization, a regulatory body monitoring process, to one of measuring outcomes. Now, I think you still will have to monitor process. You want to make sure the process that they have in place is viable and good. But you can also now, with these technologies, measure true outcomes. And, at the end of the day, you get what you measure. And if you measure process, you'll get a robust, finely tuned process. And it will pass all sorts of regulatory audits. And criminals will still put their money through that organization. If you measure outcomes, you will actually reduce the amount of financial crime trafficking through the institutions. And you'll make it much harder. Eventually, we will make it much harder for criminals and terrorists to finance their organization. And that's where we have to go. It's just where the technology is there. It's capable. We can use it. We need to change our mindset from one of process to one of outcomes. Data science, artificial intelligence, big data. It can allow regulators and financial institutions to do this.
Is the industry thinking evolving in this direction?
Oh, absolutely. Absolutely. For instance, there's increasing support for regulators themselves to start using AI and machine learning and big data technologies to audit banks, AML, and CFT compliance programs. The New York State has said that they will begin to do that. They're going to sample their non-flagged transactions. They're going to analyze them with these technologies. And they're going to see what percentage of those transactions were false negatives. QuantaVerse is working with central banks around the globe that are interested in using artificial intelligence to investigate the filed SARs and STRs that they have with them. In the U.S., we're seeing proposed legislation directed at modernizing the Bank Secrecy Act, and that's pushing for regulators to consider the use of modern technologies like AI. The Royce bill, Congressman Royce from California, has specifically stated in his proposed bill that regulators use artificial intelligence. And that push in that legislation will eventually have the regulators using artificial intelligence and machine learning to check and test banks. And interestingly, as the regulators begin to use AI for their work in the monitoring of their covered institutions, it's going to send a very, very powerful message to the banks and the other covered institutions. This technology is not only acceptable, but is going to become necessary. If the regulators using AI to test financial crime outcomes, FIs will have to up their game. And if they don't, if the industry, including the regulators, don't adapt these technologies, that gap in performance between old and new techniques is just going to be glaring.
Well, that was fantastic. Thank you so much for spending time with us, and thank you in the audience for joining this edition of On the Front Line with AI. David, we appreciate you being here, and we hope to have you back again soon.
It was great to be here, and anytime.
Good. Well, we hope you've enjoyed this presentation, and we encourage you to listen to other podcasts in this series.